Welcome everyone to this week's live stream. We'll be getting started shortly. If you have questions during the session, you can drop them in the comments. We'll be keeping an eye on those and we'll do our best to answer them live. If we don't, we will reach out to you personally. And now we can welcome your hosts, David Stoffaker and Linda Keith.
Hello, everyone. Welcome back to the live stream conversation. I'm Dave Stoffaker, the Senior Credit Trainer and with Lenders Online Training. And I'm joined with our founder and Chief Credit Training Officer, Linda Keith. Linda.
Oh, hello.
What's on your mind today, Linda?
Well, we recently got a question through our experts at lendersonlinetraining.com, which is how we get questions actually from lenders all over the place, our students, but also people that just find us on the internet. And it was about ROU assets. I have to admit, I had to look it up to understand it better. So, because I am familiar with financing leases, operating leases, etc., but I wasn't sure how these new ROU asset rules should impact what I do with those. So I know we are here to talk about leases, but we're also here to talk about my quack like a duck approach to anything I don't understand, because this is another thing we train junior lenders in, is when you run across something new, is it like something you already do know what to do with? So we're going to help you understand the differences between the financing and operating leases, but we're also going to do quack like a duck.
Quack like a duck approach? Linda, what is that?
I know. This is the fun part where people start to get to know me and then kind of go, do we really want her training our lenders? But you do, because people remember better when they learn and they're having some fun. So whenever I learn about something that is new to me, I first try to get enough information on it to see if it's like something I already know how to handle. So I did have to do some quick research on that ROU assets, because I'm not in CPA practice anymore, right? And this is something that just came in. It was effective 2022. Well, those 2022 returns don't show up till 2023, the earliest, but more likely like 2024 by the time you're actually getting them. And so we're just starting to run into this as lending and credit professionals. So I will tell you how it quacked like a duck for me. But first, I do want David to start us out explaining what some of the rules are for these leases.
All right, Linda. Okay, the technical stuff, the current rules. And this came under that ASC, the accounting standards issued by the FASB group, the Financial Accounting Standard Board. Technical stuff, I'm sorry. But it has to do with the right of use of an asset and a lease liability. Now, what does that necessarily mean? Now, basically, it's focusing on those that are leasing something that may be more than 12 months old. So that's kind of interesting. So this is true regardless if it's an operating lease or what some of you will know as a financing lease. So first of all, let's get a quick reminder as the difference between a financing lease and an operating lease and kind of the typical way of how we handle that. And then let's basically give you the old rules to demonstrate Linda's quack like a duck theme, basically. So finance, capital lease. This is kind of one where the lease term where the lessee, the borrower in our case, would own the asset at the end at a discounted cost. And it would show up on the balance sheet, which many of us are acquainted to. We see it on the balance sheet as if we were actually purchasing it, right? Both the asset side, the liability side. On the operating income statement, we would actually show the interest and depreciation, very similar to if we had the asset that we had purchased. Now, with this new implementation of this Rule 842 for private companies, the financial statements, as Linda mentioned back in 22, that now we're starting to see, the impact on cash flow really hasn't changed. So, Linda, if the financing lease does not change, what about this operating lease? Is that what's really quacking?
You know, it would seem so, because really the way we're treating the financing leases just feels like the same. It's the fact that we're adding this ROU assets and liabilities piece to the operating leases is what is different. So operating leases used to be kind of old rules. Operating leases are something that At the end of the lease, you don't own the property at an easy discount. At the end of the lease, the property or the item is not used up, right? It has plenty of useful life to go. At the end of the lease, you often don't have any guarantees that you could lease it again for the same amount. You're going to have to renegotiate what you're going to lease for. So it's definitely, during the lease term, you do have the right of use of that asset. So I'm not at all disagreeing with this accounting concept. But from the standpoint of the operating leases, we're going to see lease expense. And now we're also going to see something on the balance sheet. But from the standpoint of how we do cash flow, I don't think that's changed. I don't think that's changed. And I'm almost to quack like a duck, David. But what about now? Because we do pay attention to the balance sheet. And frankly, lenders should have been paying attention to those operating leases anyway, and they were. They would see a lease for their property on the income statement, and probably they did say, so how much longer do you have on your lease? You know, are you going to have any problems renewing your lease? What do we think is going to happen to the lease costs as they go forward? So I think we've been noticing it anyway, but it feels like what they're now doing on the balance sheet helps us notice it better. Is that your take, David?
Yeah, this really came up most recently with a client relationship that I had as I'm looking over their financial statements of this purchase, and I'm saying right of use. I didn't know what that meant, but now I have a liability and an asset on something that I was never to expect or talk about. So I reached out, in this case, to a CPA and says, can you explain to me what's going on? Because I was aware of something that just seemed unusual from my normal track record when I evaluate balance sheets. And I'm a big balance sheet guy. So this new lease liability that comes out, it looks like debt because that's where it's sitting on the asset side. So in essence, if I'm doing my traditional analysis and looking at leverage ratios, debt to equity or debt to EBITDA, it's changing a little bit, right? Because I have debt on there now and I need to be aware of it. So when you're looking at this from a lending perspective, the balance sheet, we may look at something there that looks differently from an optics perspective. But actually, it isn't necessarily going to impact my cash flow because it's not going over to the operating income statement. So I don't necessarily need to be aware of that. So I guess in summary, the view on it from a balance sheet perspective is it may change the way we look at debt and certain ratios that we look at when we analyze a financial position year after year, which what I often do with the balance sheet versus strictly going on cash flow that we're used to on the operating statement of the income tax return. But that's the balance sheet. We talk a little bit about the income statement, but now my question to you, Linda, is what about tax rules? Is this going to impact taxes now? Because that's where I want to go find it next.
That's a good point. The tax return is based on tax rules, not GAAP, right? Not ASC 842. It's based on tax rules. Here's the interesting thing. The IRS did not change their rules. So from a cash flow standpoint, with operating leases, we're going to do what we always did. You got a lease expense. That is, in fact, what was paid. So it's in our cash flow. We're good to go. Again, a prudent lender would stop and say, I wonder how soon that has to be renegotiated and how it might impact them going forward. But that was smart to do before. Here's the other thing that's interesting to me about the tax return, and maybe some of you don't realize this, but the balance sheet on an 1120, a 1065, 1120S is based on books and records. So tax return will treat the operating lease the way it always did, but the balance sheet attached to the tax return, in fact, would have that ROU assets, the liability. So you're still going to have that information. And to David's point, just consider whether any of your debt to equity or debt ratios mean something a little different. My feeling is a lease may actually have provisions in it for how you'd break the lease. That's different than what if you default on a loan, right? And a business owner could decide that the cost of breaking the lease was okay because of the benefits of this other opportunity that they have. Whereas the cost of just defaulting on a loan, they'd need to be able to renegotiate it. They need to be able to go to their bank and say, this is what I want to do. Can we, how can we get out of this? So tax is not changed. Just be aware that the balance sheet attached will look like the GAAP balance sheets. And so that's where you're going to see the ROU assets. I wanted to make another connection, which I hadn't thought of when I was planning this, but this morning I'm waking up in bed thinking of you, of course. And I realized, this is a little bit like prepaid expenses. So stick with me for a moment. If I prepay a quarter's worth of rent on a building I'm in, that's a lot of money. We wouldn't put it in GAAP financial statements. We wouldn't put it all in the month that we paid it, because that's really going to last us 3 months. Prepaid expenses are an asset, and they are a right to the future use of that building that we've already paid for. And each month, we would expense that month's share and reduce that asset, that right to get it, until it went away. So to me, the right of use of assets because they've leased a property is a little bit like a right of use of rents because we've actually prepaid them. It's the same idea. Tax return, or excuse me, balance sheets, according to GAAP, the assets include the rights, not just cash, not just assets, but the right of use. And that's exactly where this fits in. David, I want to go back to you one more time then for that cash flow debt repayment piece, and just be sure we're real clear with folks the way to look at those liabilities.
Yeah, thank you for that. So just, I guess, in a summation on this, the cash flow issue hasn't changed, but the optics are. We just got to get used to that. So the lease liability is kind of up front and center right now, right? In other words, I'm seeing something there that I have not seen before. Logically, it makes sense. So if I have a 3, 4, 5, 10-year lease, I'm obligated for it, but I want to get used to the building for 10. And we see that a lot with SBA loan financing is you got to have a lease that matches that. So we just need to be aware of that. But now they're putting it, what we'd say, front and center. We're actually seeing that. So with the operating lease, granted, we know that the expense is sitting on the income statement or on the tax return, the income statement as well. But it's how we look at it from the other, what we would say, maybe covenants, other type of ratios that we just may need to be aware of, may slightly adjust, normalize. Maybe we might use that as a figure that, okay, there's something here that may change something that we're not used to, but still the cash flow isn't. So we may need to adjust it. So normalizing, I guess what we think about is, more for optics than really what is the true economic reality. Is it really impacting cash? No, it's not. Linda?
So what's funny is once again, I'm thinking as I'm talking, which is always dangerous, but it feels to me like on the one hand, these leases, this whole thing is like the quack like the duck. On the other hand, it included this new liability that's not quacking like the rest of the ducks. So we kind of had both in this session. It's like, you got to figure out, what is this new thing? What is it like? And what is it not like? And that actually will help you. So the key points, just to wrap it up, because of 842 and the ROU assets recognition, all leases are now on the balance sheet. Tax treatment has not changed. Lease liabilities do look like debt, even for operating leases. And in a real way, they are certainly obligations, but they're kind of different. Operating lease may have termination options that debt generally doesn't have. So it feels like that being a liability kind of seems awkward. Lease liabilities will impact debt ratios. So be sure to understand how they do and how you want them to. If you're the person at your bank who's setting guidelines, take a look at your guidelines for liability as it relates to these leases and see if it's causing any kind of hiccups. And then again, once I understood what ASC 842 and the ROU assets were doing, I decided I would still treat operating leases and finance leases pretty much the same as before they changed. It quacked like the ducks. I already knew how to handle it. So there you have it. When you run into something new, do what we do with the students in our lenders online training. Instead of telling them what to do with it, we say, is that like something you already know how to do? If it's depletion, they go, what is that? I said, well, or they say, what do I do with depletion? Well, what do you do with depreciation? And they explain that and say, well, good. Depletion turns out to be, and we can explain it. So as you're doing the on-the-job training of your frontline people, keep helping them see how to handle something that is new to them, but that is just like something else. We actually use the 6 N's, which we came up with. We're doing a different live stream on that. But the 6 N's, the idea behind that is if you know categories and what to do with categories, you find something new, you can put it in a category. Now you know what to do with it. So this is another, the Quack Like a Duck is another way to help people continue in their career as they get to things that are more and more complicated by applying what they already know to the new things they get. Well, thank you for joining us today. That was fun, David. I like these. And I'm hearing that people like them too. So that's really why we do it. This is not training to us. This is like insight, higher level stuff that we want to share with you to just work with your experience and your training. So thank you for joining us today. If you have questions like this one or anything else, please get in touch with us through experts@lendersonlinetraining.com. You can ask any question at all. We will always answer you. And then it also might become a live stream or an Ask the Experts blog post. And then on the final slide, you will see some contact information for us, as well as a way to sign up for Ask the Experts yourself, which is an email service that we provide. So that you can have that drip method of learning. And of course, join us at lendersonlinetraining.com if you need to know more about how we can help your team say yes to good loans. Thanks, everybody.
Let's keep the conversation going. See you next week.